Hey YouTube, it's Dimitri. Today we're going to cover risk hedging instruments as part of our risk management series here. This video is intended just to be a nice, soft, easy introduction here to some of the most common products. So we're going to cover the history of these sorts of products here and show you little variations and exotic option kind of pieces to these as well. And then we're going to cover futures and forwards as a general class, options, and then finally we're going to go over the swaps. So when I was studying for my FRM, the Financial Risk Management designation, there's a chart in the book in the 2015 Financial Risk Manager FRM exam, part 1, Foundations of Risk Management. It's figure 2.1 in the book. That chart is from FRM and has been updated, but it was originally from The Economist from April 10th of 1993. I just really like the layout and the design, and you can see like the different sorts of options here. So if you look on the screen, just to kind of zoom into parts of these, you'll see like the first one here I have is foreign currency futures of 1972. And then you see it actually rapidly develops over time. So these are a type of futures, which we're going to talk about. And then we see equity futures, another type of futures, equity options, T-bill futures, T-bond futures. And then we get into like, futures of mortgage-backed bonds, OTC currency options, currency swaps, bank CD futures. And you can kind of look at this chart and see as we go from 1972 through 2012, there are a lot of advancements, things like ETFs being brought onto the scenes, the VIX being created, which is the volatility index here. And you'll see there's just a lot of kind of unique pieces that are put into play on this. Now, keep in mind, some of these like CLOs and CDOs and things were contributing to some of the financial crisis that we've seen here. And so this is really just a diagram of many of these sorts of financial instruments used for hedging that can be actually used in a business to help kind of manage and mitigate their risks. And then to start off with here, I'm going to assume you know absolutely nothing on terminology. We're going to dive into some of these. So a financial derivative is a financial contract derived from other assets here. So as you'll see, these contracts, which is really what derivatives and options and forwards and futures are, it's some sort of agreement to trade some sort of asset for some sort of cash or assets for assets here. But there's actually an asset underneath the contract itself. The contracts are going to be called derivatives, and they're going to be actual assets underneath, like for example, like commodities like wheat, corn, coffee. It could be stocks or bonds and debt obligations, those sorts of things that are actually just underlying the financial contracts here, which we're going to call financial derivatives. When I say the underlying asset, as we mentioned, the derivative is going to be the contract. The actual underlying asset is the asset which the contract is written upon. And you'll see here we agree to exchange or trade or buy or sell these sorts of assets here. And the asset underneath this contract is going to be referred to as the underlying asset. When I say long, so being long in a position just means you're the buyer. Short is going to be the opposite position, which is going to be the seller. And then expiration is going to be the date a contract is settled. You'll see here too, like options, we can call it the expiry date. I like expiration date. It just sounds more like generic standard English. And then finally, we're going to have physical delivery, which is going to be a contract is settled in the underlying asset. So that means I'm actually going to be giving you that asset. So you'll see here when we go through futures and forwards, if you purchased, like 100 bushels of corn, like physical delivery means I go and get 100 bushels of actual physical corn and I deliver this to some sort of address and location. Cash settlement is going to be the other side of that. Cash settlement is going to be, maybe in this example, we're using corn, but for the corn settlements, we're just going to exchange cash, the value of that asset or the underlying here. So we're not going to be actually exchanging the actual like corn or commodity or whatever for cash. And then I'm going to talk a little bit in some of these products here about the exchange versus OTC. The exchange is going to be a standardized contract on some sort of market here. So like CBOE is the Chicago Board of Exchanges. More or less, it's a standardized exchange with standardized products. And so you'll see here in a second, like an Arabica coffee contract. So one contract is 37,500 pounds. It is a standardized unit, and that is what is going to be traded on an exchange. So exchanges are really good because you can quickly buy, sell, and trade on an exchange with standardized prices and market makers and a lot of different people involved. On the flip side of this, there's something called OTC, which is referred to as over-the-counter. Now, over-the-counter is very similar because it's phones and computers all linked together, but typically you have an exact amount or some sort of custom contract that you're wanting to move or trade or buy. These sorts of assets or contracts and derivatives here might not be very liquid. So there might be a lot of people that trade these throughout the entire year, but you don't have a lot of liquidity. A lot of these sort of unique products or customized contracts that you're going to want some adjustments to are done OTC. What this means is that somebody actually just picks up the phone like a farmer or your financial broker for this and says, hey, Dimitri's got, 100 million pounds of wheat. We're looking to move all this wheat. We need to deliver on these sorts of dates. This court contract, 100 million, it's crazy. I don't know if that's a lot or not, but imagine this is crazy amount. It needs to get delivered. It needs to be an exact amount. This would typically go through OTC because if not, you'd have to buy or sell a bunch of different contracts on the exchange and try to mix and match to get that to fit. So the first derivative we're going to cover here is going to be futures and forwards here. I think this is the most natural place to start. Historically, these are kind of the most common, oldest kind of contracts here. You'll see here, for example, these contracts have existed since the Middle Ages. So it's a very common instrument to use. It's historically been around. And also the examples anchor a little bit clearer and easier to understand here. So we're going to use this example here of coffee. I'm using the Arabica coffee, July delivery. So we're going to start with futures and forwards here. They're almost the same thing, but let me get into what they are. A futures contract is an agreement to buy a specific amount of an asset in the future at a specific date here. So let me clarify this here with an example. So let's just pick coffee as our example here. A standard coffee contract for Arabica coffee on the exchange is 37,500 pounds. So if you have one contract, that's how much you're agreeing to buy and sell. And you can see in this example, it has a July delivery. So this means in July, this is when we're going to have some sort of execution of the contract, meaning the buyer is going to receive 37,500 pounds of coffee and the seller is going to deliver that. Now, the reason you would do this is if you are a farmer and you're growing a bunch of coffee, there are a lot of unknowns within the marketplace here. So you don't know if it's going to be a stellar year. So you're gonna have great rain, lots of sun. You're gonna have a super sweet coffee, harvest here. We're gonna end up being able to sell this on the market for a really, really good price. Or maybe it's a really awful year and you're gonna have awful coffee and it's not gonna be great. And so you're trying to figure out as a farmer, like, I need to plan out other purchases of whether it's equipment, fertilizers, labor, like there's all these costs and unknowns that are coming about. And as you dump all this money in, let's say you started, say you start in like September of the year before and you're going to deliver in July and you're going to be doing this process here, you want to know about what you're going to get because this reduces the risk for you. You don't have some sort of crazy price fluctuation here. And so you would enter into these sorts of future contracts saying, I have a bunch of coffee, I'm going to grow it. I will have it all packaged and ready to go, and I'm going to ship that off and deliver that in July. And I have one contract's worth, so 37,500 pounds. I will agree to do that, and we will lock in a price today so that I can make a bunch of other financial decisions moving forward, knowing that that is what I'm going to get paid here at the end of the contract. Now, on the flip side of this, you have someone like Starbucks or some sort of local coffee roaster, like Volcanica Coffee, which is an awesome affiliate of mine. But they buy this coffee when it's green and raw, and then they roast it, and then they sell it to the public, right? They want to ensure also that their price is locked in and fixed so they can do their own financial planning. So they want to look at it and say a reasonable price for this coffee is X amount. This is what we want to pay today. We don't want to have fluctuations in prices. Maybe it's a bad year for farming. Maybe it's a great year for farming. Maybe there's too much supply, not enough supply. Obviously, right, there's going to be an upside and a downside. Like if coffee prices end up going down and you buy it later at a much lower price, you're happy. But if coffee prices go up significantly, you're going to be very upset and in a tough bind here. So a lot of big companies, even like, for example, like Starbucks or these big coffee companies, I'm sure they're buying some sort of bulk deals like this on futures contracts where they're actually looking at this, and it could be even with a vendor, which is going to be a forward contract we'll talk about here in a second. But more or less what they're doing here is trying just to lock in some price so that there's less unknowns in the future, and there is some sort of guarantee of what they're going to receive financially and also in physical delivery if you're doing physical delivery. Now, as I mentioned, there is a slight difference here between futures and forwards. Futures are going to be standardized contracts that are traded on the exchange here. Typically, you'll use this for some sort of hedge. So let's say, you're Starbucks again, and you're going to be wanting to hedge the price of coffee, but you're not going to be taking physical delivery of this. Often you'll be trading in futures just because you want some sort of hedge to kind of help hedge or reduce the risk associated with price fluctuations with just coffee as an entire market here. And you'll probably have your private vendor set up that you're purchasing from. And so you don't really want the physical delivery, but it can be used to hedge that risk. Now, on the flip side of this, you can have forwards contracts, and forwards contracts are going to be OTC, meaning over the counter, more customized contracts. In these cases, you might be wanting to take physical delivery. Like I'm a big, massive coffee roaster. You could do a forward contract. Now you can also do cash settlement on forwards contracts. Let's say you have a very, very specific need. Let's say you're a small coffee roaster, for example, and you only go through 20,000 pounds of coffee per year. You don't want to buy, in this case, a full contract of 37,500 pounds because you're going to be overly sensitive to this sort of contract here because it's too large on a financial cash settlement side. If it's physical delivery as well, now you'll be stuck with an extra 17,500 pounds of coffee, which you know you can't sell. It's going to go stale and you're going to throw it out. So in this case, you would go to a forwards contract, which would be more customizable. And often you're going to link up with an actual farmer or an actual corporation that's going to be selling this later in roasting. And you're going to come to some sort of agreement in a forward contract on OTC. So there's a little diagram here on the right. You can see the coffee gets grown from the farmers on the left, gets given to the roaster on the right, and then in exchange, the roaster provides some sort of cash, but they agree upon a price today to help reduce any sort of risks or unknowns with fluctuations within that price. Now, options are the things everybody talks about here. So when we talk about derivatives, often people just assume you're talking about an option here. An option, though, is a contract that gives the option holder the right to buy or sell an asset at a predetermined price, which is called the strike price, at a specific date. So very similar to forwards and futures here. The difference is you don't have to execute. So on a future and a forward, when that date comes, that coffee supplier has to deliver that coffee, and the buyer has to actually do a receiving of that coffee or that cash settlement. So one party, which is going to be the long position in these sorts of assets, meaning the buyer of these assets, they're going to be the one that have the option to actually execute the contract or not. And I'll talk about payoffs here in a second to kind of show you why you would execute and why you wouldn't execute and how this works. But options can vary in execution styles and types here and structure. So you'll see we have what are called European or plain vanilla options. These are options that on a very specific date, let's say it's like, I don't know, like June 10th. If that's the date, that's when you have to make the decision to either exercise your option to either buy or sell some sort of asset, the underlying asset, given the option contract, which has an amount with it. And you have to execute on that exact date. And then there's something called an American option, which is quite similar. The only difference here is that the size could be the same, the underlying assets can be the same. But in an American option, you have from today when you actually purchase it through the expiration date to actually execute. You can execute at any time in the middle. And there are reasons and math behind picking the optimal date to execute and why. And then there's something weird in the middle called a Bermudan option. And a Bermudan option is going to be from today to an expiration date, but there's going to be some dates in the middle when you can execute early, but you cannot execute at any random time. You have to pick on that specific date. So let's say it's like monthly, for example, and every month you have an option on the first to execute. If you wait until the second, you can't execute till the next first. So that's how a Bermudan option works. And then you have the expiration date. So the expiry date here is going to be the actual date in that contract. These are very, very critical because you'll see maybe in a later video, time has value in money. So like if you said, I'm going to buy some sort of option that expires tomorrow, the price movement is going to be very, very small. There's only one day to move. If I said it's going to be 3 months or 6 months out, there's a lot more time for that asset to vary and change price that you could potentially make a much larger profit on here. So the expiration dates, the actual maturity of these contracts is critical because time has value and time is money. And because of that, that will actually make a lot of these contracts different in making customized combinations of these. Like you can talk about spreads and condors and these sorts of combinations we'll talk about in a future video. Don't worry about it for today. But the expiration is a very, very critical part of these contracts, as well as the size and the underlying asset. Options themselves are actually quite old as well, just like futures and forwards. There is some evidence, I guess, if you look on the internet and in textbook here, that approximately in 332 BC, ancient Greeks, there's some records of people betting more or less on futures and forwards contracts. Well, betting on a futures and forwards contract, that's an option. Right? They're saying, I bet it's going to go up, I bet it's going to go down. But there is an optional piece in there, like if this occurs, I have the option to do that. And so these option contracts were actually done back in ancient Greece. So they're also quite old. And also there's actually a practical use for options. I know they get a very bad rap, and I know a lot of people use them incorrectly, and they're used more for a gambling sort of product here. But think of it more like an insurance policy. That's really what these are. An option's going to have the rights. You're going to pay some premium up front, which we're going to show you here in a second. And then if something goes bad, more or less, you're going to have some sort of payback to help cover those sorts of losses and cover your position here. Now, this gets into the strategy of the implementation of options themselves. But an option in itself just gives you the right to buy or sell an asset at a predetermined price at a predetermined date. All right, so let me show you guys here the option payoffs. These are also called hockey sticks. They are just critical pieces here. The little kinked part in these diagrams here is going to be called the strike price. So that is the price that you agree that you will buy or sell that asset at. The blue line in each of these charts is going to be the zero line, meaning that is the price of zero. Anything above the blue line is going to be a profit. Anything below the blue line is going to be a loss. These are not the prices of the assets. These are the actual profits that you would make from buying or selling these sorts of derivative products. And so let's just start off here at the top left chart. This is a long call. So if you're long a call option here, what this means is that we are going to be the one that is holding the option, and call means you have the right to buy. So in this case, let's say K is 100. That means I have the right to buy, let's give an example of a stock, for $100 in the future, let's say in 2 months from now. So in 2 months from now, I can buy this stock for $100. Now, there's going to be a cost to this option here, right? This is like the insurance premium that you're going to be paying for this. Let's say the stock is $98 today, right? If it's guaranteed that I can buy that for $100, that's not a great deal today. But if the price rises to say 105, 110, 120 in 2 months time here, that maturity piece that we have, then I could buy it for 100 and I could sell it for whatever the market price is. So let's say I have the option to buy it for 100 in 2 months and it's 120. I'll make $20 profit on that contract here. You can see the red line, the profit line. Whatever the cost is that I pay for this is going to be negative up front. So the maximum I can lose is the price of that option contract. So let's say I pay $10 for this contract. If I pay $10, I'm already out $10. If the price goes down all the way to like $5 a share and I can buy it at 100, right? I don't want to sell it on the market for $5 and lose $95. I'm going to, let this option expire. So I take that $10 loss that I paid for this long call. I let it expire. I do nothing and I just lose that $10. So that's why that red profit line is going to be flat all the way up to some sort of strike price. Say it's 100. And then as we see that price go up, we need to go from 100 to 110 so that we can break even, right? So if I can buy it for 100, sell it for 110, there's a $10 profit, and that covers the price I paid for the option. And that's going to be where the red and the blue line cross. And then any dollar above 110 in this case, because I paid $10 for this long call, is going to be the profit portion. So if it's $111, I'm going to buy it for 100. I already paid 10. So I'm now at 110 basically for that cost. And then I'm going to sell it for 111. I'll have a $1 profit. And then moving on to the next chart here, the long put is going to be someone that holds the option, but has the right to sell that option. So in this case, if the price goes down, you make money. Again, there's going to be some sort of cost or some premium that you pay for this option. And then as the price falls and falls and falls, you'll be making more money on this long put, and you're going to see that you can have some sort of profit if the price falls here. Now, the two charts below are going to be the flips or the inverses of these. These are the people that are actually selling that option here. So a short means I sold a call option. So in this case here, the profit is going to be the inverse of the chart above. So in this case, I get paid the premium up front. So in this example, let's say I get paid the $10. I'm already up $10. If the price drops, I will still make $10 no matter what. The problem, though, in a short call, which is very risky, is if that price continues to rise and hypothetically could go to infinity, you can lose a lot of money on a short call here. But somebody has to be on the other end of that long call, and because of that, they're going to charge some sort of premium here so that they can cover any sort of expected losses as they originate these contracts over time. And then a short put is going to be the inverse of that long put. So they're the ones that are underwriting more or less this insurance contract here. And they have that premium they're going to get paid up front. But as the price goes down, they're actually going to lose money. So as long as the price is at K, that strike price, or above, they're going to be able to keep their full premium up front. As that price goes down, they're going to lose money to some sort of point, and then they will be negative and they will actually be in an actual loss. So I like to view options though more or less as kind of like a little bit of an insurance policy here. Let's say you're going to need to buy some sort of asset, whether it's a stock, or some sort of other asset in the future. Stocks are most common. But I want to buy, for example, let's say Apple stock in the future, and I want to make sure that the price doesn't go up too much. You might buy a long call today, so if the price continues to run, you would make a profit. It says if you're almost buying the asset today, but there might be stipulations on why you can or can't do that. And then also on the flip side of that, if you have something like a put option, you're going to be looking at this thinking like, I'm going to get hurt if the price falls. So if I'm expected or agreed to deliver something in the future and I'm trying to hedge that out, I don't want the prices to fall because now I'm going to sell it for a much, much lower price than I would have gotten. So you can lock that price in today by doing an option here. Now, the advantage of this, unlike a futures and a forward, is I don't guaranteed have to sell that into the future. If it does go the direction I want, I can make some money. If it doesn't go the direction I want, then I just lose that premium that I ended up paying or the cost of that option I paid for that position here. So these are great instruments to be used if you're wanting to pay a little bit of money for a premium, hedge some sort of risk, and then get the upside on these sorts of options, or if the price goes up or down, depending which side you want to be on. And then you can benefit from that, but you only lose a small premium from taking these sort of options. But again, there is a time period. They are only valid for so much time. Once that expiration hits, then you end up in a position where you have to either roll into a new contract if you're wanting to carry that hedge forward, or you need to accept the risk, deliver the asset, or make some sort of decision at that point. And then finally, swaps. I feel like swaps are the least popular out of all these sorts of derivatives here, but they're used a lot by corporate management and treasury departments, which you'll see here for obvious reasons. But a swap is an agreement to exchange cash flows on predefined dates on some sort of underlying calculation here. So these are often based on some sort of dollar amount, and that is used in some sort of calculation. How this is done, there can be exotic types in swaps and changes and how these are actually calculated. So I'm going to say it's an underlying calculation, but there is going to be some sort of asset size that defines this calculation. The calculations can vary, but often, like for example, $100 million might be what we're calculating that interest off of. Common types of swaps are going to be interest rate swaps. So for example, like a fixed versus a floating rate, which I'll show you in the example below. Currency swaps. So let's say that you are purchasing or selling some sort of asset in another country. So I'm delivering that coffee. Let's say I'm getting paid in pesos, for example, and my company operates in the US in dollars. There's going to be some sort of risk here. So I would like to do some sort of swap. So as I deliver these assets over time and I'm purchasing, for example, both sides are going to be looking at currency swaps here to kind of hedge that currency risk. So it's almost like you're getting paid the date that you execute these contracts in your currency instead of in a future date. It hedges that time fluctuation of currency exchange rates. Also, you can do swaps with commodities, credit defaults, and equity as well. I'm not going to get into all these different examples here, but the general principle of this applies where cash flows between two sorts of assets get exchanged for some sort of price. So interest rates, I think, are one of the easiest examples to understand, and they're fairly common instruments to be used. Imagine you have two companies here. And maybe they have executed some sort of deal. So let's say company A has some sort of fixed interest payment that's coming to them. So let's say they sold a bond on the market. They couldn't get a great deal on a floating rate when they went to do this. They needed to raise some capital, for example, and they went and they raised it at a fixed rate. So let's say in this example here, you have two companies. We have company A and company B. Company A has a fixed rate, meaning they have so imagine like a loan, like a mortgage, right? And it has a fixed rate of like 3.5%. They don't want that. They would like a floating rate because maybe they think rates are going to go the direction that benefit them. So they would like rates to go up. So maybe they're going to get paid more in these sorts of cash flows they have, or maybe they have some debt obligation they're paying to somebody else. You can be on both sides of this, but more or less you have some sort of guaranteed rate and you would like exposure to the market with a floating rate. So interest rates, as you guys know, with mortgages and auto loans, will bounce and change over time. Sometimes you want to have a locked in fixed rate. Sometimes you want a floating rate. Often it depends on the cost of these sorts of contracts, as well as what you think is going to happen in the future with interest rates. So in this example, company A has a 3.5% fixed rate. They're actually going to be selling to company B. Company B would like a fixed rate. They're going to reduce their interest rate risk and would like it to be constant at 3.5%. SOFR is like the old LIBOR. So if you're not familiar with either of these, this is just the market interest rate that the banks are lending at. And so SOFR here is going to be the floating rate, and that's going to be moved over to Company A. Now, in this example, you might have something like quarterly. So say every quarter, they look at this, they go through, they do some sort of calculation. So just imagine it's like a simple, like I don't know, like an auto loan payment or a mortgage payment. They calculate the interest themselves. The interest of that 3.5 gets paid to Company B. In this case, Company B then looks at whatever the SOFR rate is. Maybe it's 3.2, maybe it's 3.7, maybe 3.9, maybe 4, whatever that SOFR rate is. They calculate that interest. In this example, let's say on 100 million, as we mentioned, and then that interest of the floating rate gets paid to A, and then A pays that fixed rate to B, and more or less they're just swapping positions here and the rates on some predefined asset amount. Now, I will note in general, it's only the interest payments that will end up being swapped here. They are not actually swapping the principal amount, but an example of this is, let's say that you purchased a bunch of bonds, for example, and now you think rates are going to move, and you'd like to get a better rate, but you have so large of positions in these bonds, you can't just go and offload them onto the market. It will flood it. It will drive the prices down. You'll lose a bunch of money. One way to do this is just going to find another big corporation that has another sort of position that's in float, for example. Maybe they would like to do some sort of swap here. So this is a great way to lock in either a fixed rate or a floating rate, depending on what position you want to be in. And often companies end up in binds where you have too large of positions, or maybe the market where you're operating in for a specific sort of fixed income product isn't great here, and that's what you're trying to do. The other examples I mentioned here as well is going to be currency. So looking at currencies, you might be getting paid in one sort of denomination, and you would like to get paid in a different one. That sort of swap that needs to occur can be done through a currency swap, where often you have two companies that are headquartered in different countries, operating with customers in the opposite country, and they will just end up doing some sort of swap here. Now, of course, these are not going to be apples to apples like they just enter into this. There's actual pricing and a price that gets paid depending on market conditions and how the pricing gets set up and the expected cash flows. But more or less, there is some payment that goes into this that creates the value of these sort of swaps. When you get into things like credit default swaps, these get a little bit more complicated, so I'm not going to cover those, but those are other sorts of swaps as well. Anyways, those are the basic hedging instruments here that we covered of futures and forwards, options and swaps. I hope you found this video helpful. If you did, don't forget to like, share, and subscribe, and follow this playlist here solely on risk management. Thanks for watching, and as always, until next time.